What's going on, investors? AK here, bringing you The Noise, where we analyze the market and business news that you need to know. Let's go! Today we're going to review the broader market, see what rising rates means, and then I got a stock idea for you too, so make sure you watch till the end. First up, the broader market is looking strong. Small caps just hit new highs and overall breadth is solid. Sentiment reset itself and now it's acting as a neutral or bullish tailwind for stocks. So really the main hurdle markets have to face going forward is the rising rates. The yield on the 10-year is hovering just below 3.1%, and this chart shows that the rate of change in yields is at levels that usually precede stock market volatility. There's really a circular relationship that you see between yields and equities. When yields rise fast, you start to see a lot of stock market volatility, and that in turn pushes people into bonds, and as they're buying bonds, those yields go back down again. So it really becomes a self-correcting process. We'll probably see this cycle play out again soon with another small sell-off in stocks, but that will hopefully put an intermediate ceiling on yields, which should clear the way for a sustained stock rally. One of the stocks our team is looking into to play this rally is Discovery, ticker symbol DISCA. And you guys are probably all familiar with the Discovery Channel, which hosts Shark Week and has popular shows like Mythbusters. Discovery Inc. is a global media company that owns Discovery Channel among many others like TLC, the Oprah Winfrey Network, Food Network, Animal Planet, HGTV, and a bunch of others. They have about 400 distribution feeds in 40 different languages around the world. The stock has been beaten on by investors the last few years because of the old media narrative and the rise of cord cutting. And these are legit reasons, but now the stock is trading 50% below its price from a few years ago, and it looks like the market has overdone it. Discovery trades at just 7 times free cash flows, and insiders have been backing up the truck on its shares. Our Icon Insider buying model shows a reading of 100, which means that insiders have been buying large amounts of stocks relative to those selling over the last 2 years. One of those insiders is John Malone, who's the second largest holder of Discovery stock. He thinks that the cord cutting risk that all these investors are worried about is way overblown, because Discovery has enough high quality branded content that they should be able to make the transition over to the direct to consumer platforms real easily. Check him out in this CNBC interview.
I'm always a long-term guy, and I'm going to bet that Discovery, with its ownership and control of its content, okay, will be able to transition to direct consumer platforms in a reasonably efficient way. Okay, and if they successfully do that, then they are dirt cheap right now.
This Discovery play is pretty similar to the long Disney trade we made a little while ago. Both of these companies have deep libraries of valuable content, but both have been slow to move over to the direct-to-consumer streaming model. And with their current market valuations, the market is way over discounting their potential success. And that's what makes them good asymmetric plays. Now, if you want more videos like this one with market and stock reviews, then make sure you subscribe to this channel and hit that bell for notifications of new videos. Stay fallible out there, investors. I'll talk to you soon.